The differences between fundamental and technical trading when learning about markets is a key element to understand. These are some of the most important and most basic elements to understanding what strategy you wish to approach the markets with. And in today's video, we'll be looking at both of these approaches, discussing the basics of both fundamental and technical trading, where it is used, how useful it can be, and the application cases for either scenario. If it sounds like a good episode, please make sure to leave a like and subscribe for more educational content like this. So, let's start off by jumping in. We'll first look at fundamental trading, and we're going to focus on what this is. Well, fundamental trading is a strategy which focuses on a company's intrinsic value. That might be what the business does, how well it performs, how things work within that company. This may often encompass using financial statements, earnings results, revenue forecasts, and growth potential as well. It's really about understanding what the company is, what their business essentially revolves around, how they do it, how well they do it, and how that could affect the company long term. Is this something where the business can have value over a prolonged period of time? This approach generally considers economic indicators and the industry's outlook. They're looking at potential for this company, for the market in general, and how likely this business is to do well. Then you've got the goal, which is to find undervalued or overvalued assets for long-term trading. So to look into that a bit more, it's about finding a company with potential, finding a company which may have already reached its potential, and establishing whether, based on those elements, the business would be a relatively decent buy or not. Then you've got technical trading, which to some degree is the opposite. It's an absolutely inverse strategy that people tend to use. Technical trading often focuses more on price charts and trading volume. This can be stock movements. Whenever you see a stock analyst pulling up those screens with major green and red trading candles, this is kind of technical analysis. It uses patterns, indicators, and signals. A lot of people in this strategy will use a lot of indicators, a lot of key technical symbols on the charts, such as price, volatility, key levels of price, support, and resistance, to establish where they think that the stock is going to go next. Oftentimes, this strategy is used more in the short to medium term, and the goal is to identify potential entry and exit points for trades. So when using this strategy, it may not have the same focus, or you may not be focused to the same degree on the long-term potential of a company. It's about seeing if you have a business where there is that turnaround potential, perhaps in the short to mid-term. Now, key differences between these two strategies are actually quite easy to map out, as I'm sure you can understand. So fundamental trading is more of a long-term focused strategy. It's a sort of strategy where you may buy a company now and hold it for a long amount of time. Whenever you hear about people perhaps buying things like index funds, which they're holding until retirement, that is often based on fundamentals. It's based on the assumption that companies will do well, based on how the economy is intended to move. And again, this goes on to speak about it in more detail, right? It's based on how the company and economy data looks. When you see strong results in this strategy, when you see strong results in the economy, it may indicate strong signs to a fundamental trader. However, when you come to technicals, it's often quite the opposite, with a more short-term focus. Whenever you hear about people doing day trading or swing trading, these people are often using technical analysis, sometimes combined with fundamental trading tactics as well. Now, this is usually based on chart patterns and price movements rather than the company's fundamentals. Sometimes a company may not inherently be a fundamentally good company, but if the chart does reflect some potential, a technical trader may still have an interest in that business. Now, you've got to ask which strategy is better. And the answer is actually quite complicated, because objectively, neither is universally better. It depends on what you wish to get out of your trading journey. Some people who are more long-term investors will prefer the fundamentals of the business. Active traders may, however, prefer the technicals. Neither is necessarily wrong, right? And a lot of traders actually use a combination of the two. This may be a scenario where you're looking at the charts, the recent price movements, and the more long-term trend as well from a fundamental standpoint to essentially assess where you may find better entries. For example, if a company has just had earnings, which is a fundamental analysis to a degree, and the stock price has dropped or rocketed up, you may be able to factor in both of these factors, look to some of the levels where the stock may face resistance or support in the near-term future, and see whether it will be a better or worse short-term buy for more long-term potential based on these factors. In my personal strategy, I like to encompass a little bit of both. It's important, in my opinion, to know the context of why things are happening, to establish and understand what that is going to mean for the company in the short term. So that's a strategy that I personally like to use. Now, in conclusion, you've got fundamental and technical trading, which are the two of the most powerful approaches to the market. Again, these are the main strategies that you will hear people often speaking about. When you're looking at people who are fundamental, these are people often like Warren Buffett, people who look to companies with great earnings potential, companies with great ideas, companies with great marketability, and essentially a core company strength with economic data. Now, technicals may be the absolute opposite in a lot of instances. If you are a technical trader, you can in theory still make money on a company which isn't necessarily a good company, as long as the price action is perhaps volatile enough or moves in the right directions enough to give you the core price targets that you are looking for. So clearly, it's two very different strategies. However, like I say, you can very much encompass both. This may include strategies such as looking at the company's fundamental data, establishing where the stock price has been moving, allowing you to get a midterm trade. So it's not all about day trading, it could be more of a midterm, like a swing trade, where you trade the company over a few months. It very much depends on what you are going for in your trading journey. But I think both fundamentals and technicals provide a very interesting insight into markets, into market conditions, and into why things happen. And if you are not aware of this, I think these are two of the most important core things to learn about in your market journey. There's a lot here, there's a lot of value in understanding these two strategies. So what do you guys think? Do you prefer technicals or do you prefer fundamentals? Or do you actually encompass a mix of both? Again, it very much seems to depend on what you wish to get out of your trading journey, but I do find it interesting to hear about you guys' personal experience. Thank you for watching the video. If you enjoyed it, make sure to leave a like and subscribe, it does help me out a lot. And again, I do hope I will see you again soon. Goodbye.